Have you ever wondered what credit scores are, how they work, and why or how they matter in your financial life? Hi there, and welcome to Gimme 2. My name is Mark, and in this video, we'll explore the basics of credit scores and how they work in just 2 minutes. As with my other videos, if you want to go straight to the 2 minutes that discusses the factors affecting credit scores, that is timestamped in the description. But if you stick around for a couple of minutes before that, I discuss its history, the credit score landscape, and some other context that might be worth sticking around for. In 1956, Bill Fair and Earl Isaac started a company called Fair, Isaac & Company. They provided an algorithm calculating the risk that an individual would not pay back a loan based on information from credit reporting agencies. This has since evolved into what we call credit scores, which are used by credit card companies and lenders to decide whether to provide individuals with credit or loans and how much interest to charge on those loans. Fair, Isaac & Company has since been renamed the Fair Isaac Corporation, better known as FICO. FICO provides the most widely used credit score algorithm, and even has a number of variations, but it's not the only algorithm. The three main credit bureaus, Equifax, Experian, and TransUnion, have worked together to create VantageScore, a similar but alternate algorithm to FICO. Therefore, different algorithms mixed with multiple credit bureaus results in a variety of credit score types. Some lenders even rely on more specialized credit scores depending on the loan they're offering, such as auto credit scores for auto lenders. While there are a variety of credit scores, generally speaking, lower scores indicate higher repayment risk, and lenders will charge borrowers higher interest rates to compensate for that risk. Some low credit scores might even prevent a borrower from getting approved for a loan entirely. Therefore, it's a good idea to keep an eye on your credit scores and to take actions that keep them as high as possible. Many credit cards and banks provide free credit scores, but they can also be viewed through Discover, even without a card, and through Experian. You can also use Credit Karma, which provides your VantageScore, and, while not used by as many lenders, still provides a very useful gauge on your credit. It's also a good idea to periodically check your credit reports to make sure that the information is accurate. Faulty information can harm your credit score, and checking can also help you identify potential identity theft. One free annual credit report from each of the three main credit bureaus is available from annualcreditreport.com. The actions necessary to improve your credit score can vary significantly from person to person. While this video won't cover all of those situations, you can work with credit repair companies to identify and fix aspects affecting your score. You can also get an idea of which areas of your credit can be improved, as will be discussed in the 2 minutes. Before we start the 2 minutes though, if you find this content helpful, informative, or entertaining, please consider smashing that thumbs up and subscribing to the channel. This can help you stay current with my releases and helps videos like these reach wider audiences. Now that the self-promotion is done, let's get back to those 2 minutes starting now. The two main credit scores used by lenders, FICO and VantageScore, typically range from 300 to 850, with higher numbers representing better credit worthiness. Both FICO and VantageScore use similar info to calculate your scores, but given greater popularity amongst lenders, we will focus on FICO's. The most important credit report factor is payment history. Lenders want to see that you're paying your bills and loans on time. Late payments can lower your score, so make sure to stay current to keep your score in good standing. Credit utilization looks at the amount of credit you use versus your credit limit, and also plays a large role in your score. High balances that push up against your allotted credit might indicate that you can't handle additional debt, lowering your score. Try using below 30% of your credit limit by maintaining multiple lines of credit or by paying off your credit more frequently before it builds too high. Length of credit history plays a smaller but not insignificant role, giving lenders larger sample sizes, increasing their confidence that you can pay your loans, thus improving your score. Experts say that you shouldn't close old credit cards, even when not in use, keeping that credit history going. A lesser factor looks at your credit mix, such as credit, mortgages, and loans. A variety of credit types can indicate your ability to handle a variety of different payments, increasing your score. Applications for new credit can temporarily drop your score by a couple of points, as credit providers will run hard inquiries on your credit. Too many inquiries and credit applications might signal cash flow issues to lenders, lowering your score. Experts recommend limiting applications to 2 per year. And that's it for our overview on credit scores. Remember, credit scores can have huge implications on your financial life, so it's important to understand how it works and how you can improve it. Thanks for watching, and I hope to see you in another video.